If you had $10,000 to invest, would you invest a little bit every month? Or would you wait and pounce during a market crash? Dollar cost averaging versus buying the dip, two popular strategies. But which one actually works better? Stick around, because the answer might surprise you. Section 1. What is dollar cost averaging, DCA? Let's kick things off with a strategy called dollar cost averaging, or DCA for short. Now, don't let the name intimidate you. It sounds like something out of a Wall Street textbook, but it's actually one of the simplest and most powerful ways to invest, especially if you're just starting out. Here's how it works. You invest the same amount of money at regular intervals, whether the market is up, down, or completely flat. It could be $100 every week, $200 every month, even $50 bi-weekly. Whatever fits your budget. The magic lies in consistency, not the amount. Let's make this real with a quick example. Say you decide to invest $200 every single month. In months when the stock price is high, your $200 buys fewer shares. In months when prices drop, that same $200 scoops up more shares. Over time, you're averaging out the cost you pay per share, hence the name dollar cost averaging. You're not trying to time the market. You're not panicking over news headlines. You're just investing on autopilot. And that's the beauty of it. It removes the emotion and guesswork from investing, which, let's be honest, is where most people mess up. It's especially perfect if you have a steady paycheck. You get paid, you invest, you move on with your life. No stress. No second guessing. Just progress. Simple. Consistent. Automatic. Think of DCA like planting seeds every single month. Some months the weather is better, some worse, but over time, those seeds grow into something big. Stick with it long enough, and you won't just have a garden, you'll have a whole forest of wealth. Section 2. What is buying the dip? Now let's talk about a more hands-on strategy you've probably heard before. Buy the dip. Unlike dollar cost averaging, which runs on autopilot, this approach is more active, and honestly, a bit riskier. Here's how it works. You hold onto your cash. You stay on the sidelines. And you wait for the market to drop, a dip, a correction, a crash. Then, you jump in and buy while prices are low. The logic is simple. Stocks are on sale. You're getting more shares for your money. And if you catch the dip at the right time, your gains on the rebound can be massive, way more than if you were investing little by little. Sounds smart, right? But here's where things get tricky. First question, when's the next dip? Nobody knows. Not even the experts. And if you're just sitting and waiting, you might miss years of steady market growth. Second, will you actually have the guts to buy when it happens? Because here's the truth, when the market crashes, it's not calm and quiet. It's chaos. Headlines are screaming. Social media is panicking. Your friends might be pulling their money out, not putting more in. It's easy to say buy the dip when things are calm. But in the moment? It takes serious discipline and emotional control to hit that buy button when everything feels like it's falling apart. And if you wait too long, you might miss the dip entirely, and end up buying back in when prices are already recovering. So while buy the dip can work, it requires timing, patience, and a strong stomach for risk. For most people, that's a tough combo. It's not a bad strategy, it just takes a different mindset. You're not just investing money. You're betting on your own ability to stay calm when everyone else is panicking. And that's not as easy as it sounds. Section 3. A fictional example. Let's make this real with a simple story about two friends, Emma and Jason. Emma uses dollar cost averaging. Every single month, like clockwork, she invests $500 into a low-cost index fund. No matter what the headlines say, no matter what the market's doing. Rain or shine, bull market or crash, she stays consistent. Jason, on the other hand, is a dip buyer. He holds onto his cash and waits for the market to drop by 10% or more before he makes a move. Over the course of 5 years, here's what happens. Emma invests every month. She buys when prices are high, low, and everything in between. Her portfolio grows steadily. No drama, just discipline. Jason only buys during big dips. And in those 5 years? The market only dropped enough 3 times. That means most of the time, Jason was just waiting, watching, and missing out. So, who ends up with more money? Most of the time, it's Emma. Why? Because her money spent more time in the market, quietly compounding. While Jason was trying to time it perfectly, Emma was letting her money work. And that's the lesson. Time in the market usually beats timing the market. Perfect timing sounds great. But consistent investing? That's what actually builds wealth over time. Section 4. Interesting research. Let's dive into a fascinating study from Charles Schwab that tested a simple but powerful question. Which type of investor actually performs best over time? To find out, they looked at 5 different investing styles, each representing a common approach people take with their money. Let's break them down one by one. 1. The perfect timer. This is the investor we all wish we could be. They somehow manage to buy at the absolute bottom every single time the market dips. Never early. Never late. Just perfect timing, again and again. Totally unrealistic in real life. No one can predict market bottoms consistently, but it serves as the benchmark for best-case results. 2. The consistent investor. This person uses dollar-cost averaging, DCA. They invest the same amount, at regular intervals, monthly, bi-weekly, whatever, regardless of what the market is doing. They don't try to time anything. They don't panic or chase hype. They just show up consistently. It's simple. It's automated. And it removes emotions from investing. 3. The bad timer. This poor soul has the worst luck. They always end up buying at the top, right before the market takes a hit. It's like they have a sixth sense for doing exactly the wrong thing at the worst time. You'd expect this person to perform terribly, right? Well, not quite as bad as you'd think. More on that in a second. 4. The market watcher, aka the hesitator. This investor is constantly waiting for the right time to invest. They watch the news, follow market trends, read forecasts. They're always almost ready to invest, but end up holding cash far too long, trying to time the market perfectly. And while they may avoid some losses, they also miss a lot of gains. 5. The all-in at the start investor. This person takes a bold approach. They invest a lump sum all at once, right at the beginning, then leave it untouched. No further contributions, no changes, just set it and forget it. This approach can work well in a long-term bull market, but it also exposes you to the full brunt of any early downturns. So, who came out on top? The perfect timer won, obviously. If you could somehow always invest at the lowest point and ride the market up, you get the highest returns. But again, this person doesn't exist in real life. The consistent investor came in a very close second. And that's the real takeaway. Despite never timing the market, despite investing through ups and downs, the person who just invested steadily over time nearly matched the impossible perfect timer. Even more interesting? They beat the market watcher, who waited too long and missed growth. The bad timer, who always bought at the worst time. And sometimes even the all-in at the start investor, especially if the market dipped early on. So what does this tell us? It tells us that consistency matters more than timing. Time in the market beats trying to time the market. Even bad timing is better than no investing at all. Because the market rewards long-term participation. The more time your money has to grow and compound, the more wealth you build, regardless of short-term fluctuations. Trying to outsmart the market might feel smart. But most of the time, it leaves you sitting on the sidelines, missing out on gains while you wait for a perfect moment that never comes. Meanwhile, the consistent investor quietly builds wealth, one contribution at a time. Section 5. Can you mix both strategies? Here's a little twist most people don't think about. What if you didn't have to choose just one strategy? That's right. Some investors actually combine both. They stick with dollar-cost averaging every month. Automated, steady, no stress. But they also keep a small chunk of cash on the side, ready to deploy if the market suddenly drops. It's like having the best of both worlds. You get the discipline and consistency of DCA, plus the opportunity to take advantage of those rare everything's on sale moments. Think of it like this. Your DCA contributions are the engine. They keep your wealth building moving forward no matter what. Your dip buying fund? That's your turbo boost, something you only use when the timing feels right. Personally? That's exactly what I do. I invest 80% automatically, same day, every month, no thinking involved. The other 20%? I keep it flexible. If the market drops significantly, I'm ready to act. And if it doesn't? No big deal, I'm still making steady progress. So you don't have to pick sides. You can build a strategy that's both smart and adaptable, and works for you. Section 6. The psychology of investing. Let's be honest. When it comes to investing, the biggest challenge isn't the market. It's you. It's us. It's our own brains. See, we're wired to hate losing money more than we enjoy gaining it. Psychologists call it loss aversion. And it's powerful. So when the market drops 10%, 20%, even 30%, most people don't think, ooh, buying opportunity. They think, get me out before I lose everything. That's why so many people sell low and buy back high. Fear takes over. And that's exactly why dollar cost averaging works so well. It removes emotion from the process. You're not trying to guess. You're not reacting to headlines. Your money just goes in, automatically, no matter what. Now, buying the dip sounds exciting. And yes, it can work. But only if you have the discipline to invest when it feels like the world is falling apart. So ask yourself, can I really stomach a 30% market drop and still press buy? If the answer is no, that's okay. It just means DCA might be your best friend. Because the best investing strategy is the one you can actually stick with. So, dollar cost averaging versus buying the dip. One is steady, consistent, and a little boring. The other is bold, tactical, and takes guts. But in the long run, boring usually wins. Now it's your turn. Which strategy do you use, or plan to try? Drop a comment below, I'd love to hear your thoughts. And hey, if this video helped clear things up, give it a like, and share it with a friend who's stuck waiting for the perfect time to invest. Because remember, time in the market beats timing the market. Thanks for watching. Keep investing. Keep learning. And I'll see you in the next one.